Investors, if you've been following Oak Harvest and our investment commentary for any time, let alone for the last 5 years, we've been posting publicly. It's safe to say you're aware of my love of the study of the stock market, economic cycles, and market history, including presidential cycles and seasonal trading behavior in the stock markets. Why do these things keep working more often than not? Most likely because investors are creatures of habit, and when certain external stimuli hit, they repeat their emotional behaviors and investment actions in similar fashions time and time again. The Oak Harvest investment team had been discussing the likely V-bottom in stocks since mid to late April, well before the historic rally took hold. While many others were talking doom and crashes, we discussed for weeks in our videos. Looking back, April 7th was what we thought was the low for the overall S&P 500 index and US stocks, most likely for the rest of 2025, x the unforecastable black swan event. The minus 20% bear market correction was largely event-induced by President Trump's unforeseen tariff policies, x the great financial crisis in 2007-8 and the popping of the speculative dot-com bubble frenzy in 2000-2001, which did precede longer and deeper recessions. History said enough damage had been done and we would V-bottom in similar fashion as the V-bottoms in the last 20 to 30 years. And investors, the real good news here, this V-bottom happened without the Federal Reserve intervention and interest rates cutting. More Fed cuts are in front of us. Think of that, investors. We're at marginal new all-time highs in stocks and the Fed is paused. For months, we've discussed how the charts in the economy look remarkably similar to the period that was mid-dot-com, not peak.com, back in late 1998. The period in October 98 bear market sell-off was caused by an event, hedge fund long-term capital blowing up. After 3 months, 20% rally, a few strategists have caught on to this and are ratcheting back up their 2025 S&P 500 targets, just as we said they would 2 months ago, and are now preaching bullish upside numbers for the rest of the year. Just last week, with July starting, I was flooded with bullish pieces written largely by those who just missed the V-bottom rally, discussing the wonderfully positive seasonal tendencies of July to be the second best performing month of the year. I'm here to bring you good news and bad news. First, the good news. Yes, investors, there is a Santa Claus, and besides late in the year, historically, he also comes in July in the stock markets. Here's a data table showing the monthly seasonality of the S&P 500 over the last 15 years. This is data from Bloomberg, but most data sources should show the same thing. Historically, July is the second best month of year returns for stocks, lagging behind only November. Here's the same seasonality chart using only the last 5 years since the COVID lows. The numbers sum and are averaged slightly differently, but the message and the outcomes have been the same over the last 5 years. November has been on average the best month of the year for stocks, with July only slightly behind in absolute returns. Hooray, let's rejoice. Now that we've rallied over 20% in 3 months, let's get bullish, let's get long, and if you're a trader, let's get margined and swing for the fence, right? No. Detect my sarcasm. Why? Because the reason behind this week's title, Nothing But Net, I love college basketball. Loved playing basketball when I was younger. I watched the NCAA basketball tournament every year. And yes, I had a pretty good jump shot back in the day, but there are very few who need a 6'2" slow guy who can't jump but can shoot from the outside. Even 40 years ago. Not a lot of demand for that skill. Notice the bold words in the title, nothing and net. Why? Because as much as you might be hearing about the bullish trading window of July, which now has about 9 trading days left, you haven't been told that historically, if you walked away now and came back in early October, you would miss nothing from a total return market perspective. Nothing net. In fact, net historically, you'd lose money between the end of July and the first few weeks of October. Instead of getting FOMO or fear of missing out here, how about taking a deep breath and exhaling and slowing down and thinking, if August and early October tend to be stalled at best and down most years, what do I want to wait for and buy on a third quarter slowdown? Is it caused by a minor uptick in inflation from tariffs or a slowdown in the real economy due to a pause in demand after a pull forward of inventory building and pull forward of buying in front of the tariffs? What stocks and groups would I want to own on the other side of a late summer and early fall downturn? Hence, nothing but net for this week's title. Investors, the pattern does remain bullish, and yes, historically, July is one of the better returning months for the S&P 500, with earnings and buybacks just around the corner. Up and to the right is good, New all-time highs are not bearish historically. That said, after rallying for almost 3 months off the April lows, do not expect the pace and percentage gains of stocks to continue at this rate. Expect the pace to slow. Investors, we do expect a normal late summer pullback in the markets, but investors, you most likely won't see those low levels of April again for quite some time, if at all, this year. Many institutions got way too bearish near the lows in April and de-risked, and they're already way behind the performance curve for the year. As this plays out, our team has stuck with our 2025 year-end target of 6,600, even as stocks sold off into April, and most strategists slashed their targets from over this number to the low 5,000s, and now guess what? They're raising those targets once again. Does this mean that you shouldn't add to stocks, particularly if you're younger and in saving mode and accumulation phase? No. Why? Because rarely can you pick the absolute level in both price and time on both the buy, the sell, and the buy side once again, particularly in growth stocks, as we've covered in prior videos. New all-time highs are not bearish. Investors, regardless of the path for the economy and the financial markets in the next few months, the investment team here at Oak Harvest will be here, crewing the ship and adjusting our models where we can. Until next week, have a blessed weekend and know that the Oak Harvest team is doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.